Knowing how to adjust to current conditions is probably one of the most important and most difficult skills to learn as a trader. I struggled with this so much early on in my trading career. There were many days where I took huge losses during times when there really wasn't any reason to trade, or worse, I was trading completely against the flow. These days, I'm much more selective, and that has come from a deeper understanding of order flow and liquidity. When you combine an understanding of the current liquidity conditions with informed trading, it is a lot easier to know how and when to trade. That's why the next part of our order flow series is all about key order flow conditions. See, in previous videos, we talked about DOM basics and some common situations like catching the edge, icebergs, and large orders, things that are happening from moment to moment. In this video, we're going to take those moment-to-moment occurrences to build a mental model of what the overall conditions are at that time. We can then adjust our strategies to better account for the current order flow conditions. So let's do it. Hi, I'm Speculator Seth, and welcome to the fourth video in our series about order flow. This video series has been doing really well, in part because of you dedicated subscribers. Your comments in particular really add value to the conversation. Today, we're talking about different types of order flow conditions, so I'd love to know what kind of action is your favorite to trade. I'll leave my own comment below, but I think you regulators already know what I'm going to say. Also, don't forget to subscribe and click the bell icon so that you're sure to catch future videos in our order flow series. In the next video, we'll start to get into the juicy stuff, advanced knowledge that you don't want to miss. So yeah, that bell icon is a really useful tool. Make use of it. Now, the key to understanding current market conditions is understanding how liquidity affects the impacts of trades. And this is best illustrated by looking at the two different extremes. We actually talked about these two extremes in a previous video. I'm talking about catching the edge and icebergs. I'll make sure to put a link somewhere on the screen in case you haven't watched that video yet. Anyways, catching the edge is a special situation where there is a low amount of liquidity at that price. When liquidity is so low, it does not take many orders to make price tick up. An iceberg is the opposite situation. That's a situation where there is more liquidity, and as such, it will require more market orders to move price. Differences in liquidity is why we can get large price moves driven on relatively small amounts of volume, or tight ranges with huge amounts of volume. The more liquidity there is, the less impact market orders will have on price. And on the split side, less liquidity means market orders will have more impact. So you see, it all comes down to the orders that participants submit. That might sound simple, but it quickly gets complicated. So to help us sort things out, I want to introduce a model to you. This model was developed by market microstructure researchers at the University of Santa Fe and is thus lovingly referred to as the Santa Fe model. Now, I'm not going to go into all of the complexity of the Santa Fe model, but a key insight of that model that I want to highlight to you is this. There are three basic actions a market participant can take. They can submit a market order, they can submit a limit order, and they can cancel that limit order. Each of these actions can be done for either a buy or a sell order, thus giving us 6 fundamental forces in the order book. Now, we could try to look at all of the different combinations of these 6 forces, being weak or strong as a different type of market conditions that we need to be aware of. Once you look at the number of combinations, though, you quickly realize that that's just not practical. So instead, we want to look at the individual forces themselves. As we're watching the order book, we're essentially looking for changes in these forces that might affect how we want to trade. So let's explore this more deeply by talking about different types of trends. Of course, we're all familiar with trends where price consistently moves in one direction. You've probably made a ton of money off of a trend before, or you've lost a ton of money off of a trend before. But what most traders don't realize is that there are different types of trends based on which of our forces are dominating at that moment. See, most of us think of those exciting moves where key levels are breached over and over again, but we forget about those slow bubble up moves where the price drifts up like a slow moving freight train. Both have persistent trends in price, but are driven by different types of order flow. That exciting move we're familiar with is dominated by market orders, whereas the freight train move is dominated more by limit orders. It's a different mix of orders, and as such, you'll probably want to trade those conditions differently. Those exciting moves are driven by market orders and are all about the market orders overwhelming liquidity. You might see huge limit sell orders show up only to get completely plowed over by the market buy orders. Now, taking out liquidity in this fashion puts quite a bit of stress on the liquidity providers. Market makers may become reluctant about providing liquidity, which can lead to deep pullbacks. We call these locations liquidity holes, something that will go into more detail in a future video about why those form. But I think some of you might be familiar with this kind of move all too well. You're not sure if it's really going to move up, and then the market moves without you, so you end up chasing it only to get in at the high. Price comes back, and as soon as you give up on the trade, the market rushes back up to another new high. If you predict the conditions correctly, though, you can avoid all that drama altogether. The first trade is usually the best trade, and if you catch it just as the trend reveals itself, you can avoid all of the volatility that happens when everyone else tries to jump in. You can also just try taking it as she goes for the small winner. That means hitting into those big orders and getting out when everybody's stops are triggered. And of course, there's the more traditional approach of just waiting for that pullback. It seems that those never seem to happen when you need them. The freight train, on the other hand, is really good at convincing you that it's about to turn around at any moment. So this is the kind of move where you market sell, hoping for a reversal, only to be met with a wall of limit orders. And once you stop out, you'll see something else that makes you think that you were just a little bit too early and the cycle starts all over again. Or maybe you realize it's a trend, but it's just really hard to get filled in a good spot or find a clear entry signal. See, freight trains don't give those big pullbacks or clear inflection points. And so in these situations, all you can do is get in and be patient. It's a slower move, but if you stick with it, these moves are almost unstoppable. In fact, they often end up morphing into that market order driven move as everyone realizes what's happening. Now, let's say that you have a piece of information that you are pretty sure is going to predict a trend for that day. How do you know which of the order flow conditions we'll see? Well, something that might help is realizing that market orders are used when things are more urgent. Informed traders tend to prefer using market orders, whereas hedgers and higher time frame players may prefer to use limit orders. There's also orders canceling, which is more like short-term players changing their minds. Speaking of orders canceling, that also plays into the current conditions. It's a part of our model, right? Remember that there are three actions. There's always going to be some amount of orders canceling from usual market maker activity. However, sometimes one side might see more orders canceled than the other, and that can have a pretty predictive effect on price. That means less liquidity on that side, making it easier for market orders to push through. It's usually a subtle thing, but every once in a while, we get a market where this is a more dominant factor, just like the types of trends that we already talked about. These trends are kind of more of a tricky market though, because we're not very good at paying attention to the orders canceling. Traders tend to be much more interested in what the market orders are doing. They're also tricky because they're just not as common. However, there are two situations where I found that you'll run into this sort of market. The first is when the real move is really happening in a different market. The robots are simply adjusting what limit prices that they want based on the correlations. Now, I'm not a huge fan of trading these moves unless I think the move is going to be a really key trend. The correlated instrument never seems to go as far as the start of the show and is just a more difficult trade. It's still important to keep an eye on such things though. Once you work out how each market is moving and thus where the money is moving to and from, you have a better chance of identifying why these flows are occurring. I've also found this kind of action to be common when a market is falling, but there's not active panic, like when interest rates are rising and the treasuries fall, something we may be seeing a lot of soon, so pay attention. We saw a lot of this when treasuries fell in 2017, and I expect we'll see it some more in 2022. Now, when treasuries first start to drop, it can be a little bit wild. We definitely saw that this past week. But when the market starts to accept that rates are rising, you will tend to get more of like a buyer's strike. It seems like a level is going to hold, and then it just falls through for no reason at all on almost no volume. This isn't like the level break where the market orders overwhelm the limit orders per se. Instead, the bids just jump out of the way and it breaks to new lows rather unceremoniously. The trick here is being picky about what price you get. Try to get filled at the higher end of the range. It's hard to know when that support is going to evaporate, and that makes the as she goes trade you take in the market order driven market hard to pull off here. Instead, you want to leverage your superior positioning and squeeze out the other side. Again, you can submit a market order, you can submit a limit order, or you can cancel a limit order. Ask yourself, is there something about this situation that would cause people to use more or less of these actions than usual? Does the situation require the urgency of a market order? Are participants being more passive in using limit orders? Are they changing their minds and canceling their orders? What's going on in the market and what the participants are thinking can lead to different orders and thus different order flow conditions. Now, where the real skill comes in is being able to recognize what the current conditions really are. This is where we use some of the smaller setups we talked about in the other videos, like seeing icebergs, large orders, and places where you can catch the edge. These are all like road markers that you can use to determine what kind of market we're moving into. For instance, if we're in a freight train market, you're probably going to see a lot of icebergs. You may also see the overall liquidity in the market increase. Large operators like to add liquidity to the market to assist their operations. So if the treasuries go from normally having 3,000 per level one day to having 7,000 per level another day, there's a pretty good chance that multiple large players are more active in the market that day. In fact, that's exactly what we saw happen back in 2019, just before treasuries started their bull run. On the other hand, if we're in a market order driven market, we're going to see lots of opportunities to catch the edge and liquidity in front of us canceling. We might see liquidity reduce overall, like we saw during the liquidity crunch of February 2018 or during the most brutal days of the COVID crisis. Now, our objective is to predict future orders. So if our trade premise is good, then we should see the orders start to come in, creating the conditions we were expecting. And if we see any of these setups in a situation that we just find bizarre and we're not seeing the order flow that we wanted, that means we might need to rethink the trade. And that's where this kind of framework can become very powerful. So let's try to formalize things a little bit by creating a step-by-step process that you can follow every day. Step 1, do your research. Before you start trading, read summaries of the overnight news and any background information relevant to upcoming economic reports that day. Next, make a list of order flows that you might see that day based on your informational edges. Then identify what kind of market conditions those flows will create and whether you want to favor the long or the short side. When you see one of these flows start to materialize, try to take a position at a favorable price. If after getting into your trade, the order flow doesn't match your expectations, get out. Knowing when you're wrong quickly allows you to minimize the amount of risk you're taking on in each trade, and being informed helps you keep a higher win rate. That doesn't make trading easy, but at least you'll have a fighting chance. So that was a lot of information. I think that is enough for today. I will see you guys in the next order flow video. In the meantime, stay profitable, friends.